People are always asking me the same thing. What's the secret, Jesse? How do you catch the big money in the market without getting chewed up in the process? And I tell them straight, there isn't any secret. The market itself tells you everything you need to know if you'll only listen. That's where this whole idea of the line of least resistance comes in. And if you remember the previous video on catch big moves before they start, you'll see how this ties naturally into the next step of trading wisdom, following the path the market is already cutting for you. Now, let me ask you, when you push water down a hill, does it climb back up to meet you? Of course not. It runs downward through the cracks, finding the easiest channel until it settles. The market is no different. Prices move where the pressure pushes them. They seek their own level, their own natural path, their own line of least resistance. And the trader who fights against that, well, he ends up broke, angry, and blaming everyone but himself. I learned this truth the hard way, as most traders do. Early on, I thought I could outsmart the tape. I wanted to buy when it looked cheap and sell when it looked expensive. But what does cheap or expensive mean to the market? Nothing. The tape doesn't care about your notions. It only cares about supply and demand, and the visible expression of that force is price movement. That's all. Sooner or later, every trader learns that he must ride with the tide, not against it. And that's exactly what this line of least resistance is. Think of the tape as a living thing. It has moods. It has habits. When it wants to go up, it will go up. When it wants to go down, it will go down. You and I can't stop it. The newspapers can't stop it. Not even the biggest operators can fight it for long. So, the only sensible move is to recognize the current, step in when the flow is in your favor, and get out when it turns. Isn't that what every sensible person would do in any other walk of life? You see, a trader doesn't need to know why the market moves. That's the biggest mistake amateurs make. They're always looking for reasons. They want a news story, an earnings report, a whisper from Washington. Forget it. The why doesn't make you money. Only the what does. The what is price, and the price will always follow the line of least resistance. That's where your money is. That's where your focus should be. But let's get practical. How do you recognize this line of least resistance on a chart? Well, it's simpler than most people think, though it takes discipline to see it. If a stock is making higher highs and higher lows, the resistance is downward, and the line of least resistance is upward. That stock wants to go higher. If it's making lower highs and lower lows, the opposite is true. It wants to sink lower. Do you see how straightforward that is? The action itself reveals the tendency. You don't need any elaborate formulas. Just your eyes, your brain, and the tape. Now, I'll tell you something. A stock doesn't rise simply because you bought it, and it doesn't fall because you sold it. Many traders act as though that were true. They cling to a losing position, hoping the market will come back to their opinion. But the market doesn't owe you a reversal. When you're wrong, the line of least resistance makes that clear. The stock moves against you. And if you're wise, you'll cut your loss quickly and step aside. If you're stubborn, you'll wait and wish, and the market will take every last dime from you. Which kind of trader do you want to be? Discipline is the trader's backbone. You must train yourself to follow the tape, not your emotions. When the market shows you its hand, you don't argue, you obey. If the trend is up, you buy. If the trend is down, you sell. It's not glamorous, but it works, and isn't working what matters most. Of course, patience is just as important. Sometimes the line of least resistance doesn't show itself right away. Prices can drift sideways, waiting for the pressure to build. That's when the amateur grows restless and jumps in too soon. He thinks he's clever, anticipating the move. But 9 times out of 10, he gets shaken out before the real trend begins. The professional, on the other hand, waits for the market to tip its hand. He doesn't guess, he observes. He waits for confirmation. That patience pays off, because when the move finally comes, he's already in step with the flow, and he rides it with confidence. And let me tell you, confidence is everything in trading. Not the false confidence of opinions or tips, but the earned confidence that comes from reading the tape correctly and acting in harmony with the line of least resistance. When you have that, you can sit tight through the fluctuations because you know you're on the right side of the market. Do you feel how different that is from gambling? You see, trading isn't about catching every wiggle. It's about catching the big swing, the real move, the tide that carries your profits far beyond what you could make by scalping a few points here and there. And how do you catch those big moves? By aligning yourself with the line of least resistance. This is why, back when we talked about catching big moves before they start, the principle was so crucial. Because once you've identified the start, the next job is to follow the flow, to stay with the line, and not to fight it. Every winning campaign I've ever had came down to this. The big money wasn't made in the buying or the selling. It was made in the sitting. And you can only sit when you know you're in harmony with the market's natural tendency. That's the line of least resistance. It gives you the conviction to stay put. Without it, you'll be in and out, chasing shadows, losing commissions, and wearing yourself out without ever building real profits. But let's pause for a moment and look at the mindset behind this. Because trading isn't just about charts and prices, it's about you, the trader. Are you willing to bend your will to the market? Are you humble enough to admit when the flow is against you? That's where most people fail. They bring their ego into the market, and the market smashes it flat. You've got to be like water yourself, adaptable, flowing, never rigid. Do you see the lesson here? Price always seeks the path of least resistance, just like water running downhill. That truth may sound simple, but in it lies the whole secret of trading, the core of market law, the principle that separates the winning operator from the losing amateur. A market, like water, does not waste energy climbing back against gravity, and it does not wander aimlessly when pressure builds. It moves where it can move most easily, where the weight of supply or the demand of buying can find its channel. If you understand this, you begin to see the market for what it is, not for what you wish it to be. Think about water for a moment. When rain falls on a mountain, it doesn't hesitate. It doesn't hold a committee meeting or consult a forecast. It runs downward immediately, without thought, through the grooves and channels that gravity provides. The mountain itself shapes its path. The water has no choice but to follow that natural slope. Price action behaves the same way. When a stock wants to go higher, it does so because the path upward is clear, because demand outweighs supply and buyers are ready to lift it. When a stock wants to go lower, no amount of wishing or talking will change that fact. Sellers outnumber buyers, the pressure tilts downward and price falls into that natural groove. Now, have you ever noticed how traders complicate this? They'll argue endlessly about whether a stock is cheap or expensive, whether earnings justify a certain price, or whether the economy supports a move. But does the water ask permission before flowing downhill? No. It simply obeys the law of nature. In markets, the law of nature is supply and demand, expressed in prices on the tape. That's all. If you fix your eyes on that, you strip away the noise and begin to follow what truly matters. When you look at a chart, what do you really see? Not lines and candles, not colors or numbers, but the footprints of buyers and sellers pressing against one another. Each tick is a battle won by one side or the other. Over time, those battles trace a pattern. That pattern is the slope of the mountain. If highs keep getting higher and lows follow suit, the mountain is tilted upward, and the water, the price, will flow higher. If highs get lower and lows follow lower still, the mountain slopes downward, and price runs down with it. Is it not plain once you view it this way? But here is where human weakness enters. The amateur looks at a rising price and says, "It's gone too high. It must come down." He's fighting gravity. He's expecting water to flow uphill. And then he wonders why he drowns when the market keeps running higher. Or he sees a stock sinking and says, "It's too cheap to go any lower." That's the same mistake, expecting gravity to reverse itself simply because he believes it should. The tape does not bend to your wishes. The line of least resistance is stronger than any opinion, stronger than any tip or theory. Do you see the danger of calling tops and bottoms? Everyone wants to buy at the very bottom and sell at the very top. But that game is for dreamers, not traders. A trader doesn't need to pick the lowest tick or the highest tick. He only needs to identify the slope of the mountain and ride with it. If it's sloping upward, he buys. If it's sloping downward, he sells. If it's flat, he waits. That is all. Doesn't that sound far more sensible than guessing reversals? And yet, the temptation is always there. The novice says, if I can catch the very bottom, my profit will be bigger. True, but how often does he catch it? 1 time out of 10, maybe less. And the other 9 times, he's stuck in a losing position, waiting for the tide to turn, while the professionals are already flowing with the water, piling up profits by doing the obvious. The obvious is often the hardest thing for the human mind to accept. Why? Because ego gets in the way. Ego wants to be right, to be clever, to outsmart the tape, but the tape doesn't reward cleverness. It rewards obedience. There is another point to grasp. Water not only flows downward, it also avoids obstacles. Put a rock in its way and it flows around it. In markets, resistance levels are those rocks. When a price approaches a level where sellers have stood firm before, it may hesitate. But if the buying pressure is strong enough, if demand is overwhelming, the water will surge over that rock and keep moving. That's the breakout. And once the breakout occurs, the path forward is often smoother because the obstacle has been cleared. Have you noticed how prices often move faster after breaking through resistance? That's the water rushing freely after pushing past the dam. Support works the same way in reverse. It's the floor where demand has proven itself before. Price may bounce when it reaches that level. But if sellers overwhelm it, the floor collapses, and the price plunges because the next natural path lies lower. That's why support breaks are so dangerous. Traders who expected the floor to hold find themselves trapped, and their forced selling becomes the fuel that drives the move lower. Do you see how the line of least resistance is not just about direction, but also about the ease of continuation once obstacles are cleared? Now, think about the psychology behind this. When prices flow along the line of least resistance, they gather momentum. Other traders notice. They jump in. The flow strengthens. It becomes self-reinforcing. That's why trends persist longer than most expect. The amateur keeps looking for reversals, while the professional rides the stream, knowing that water tends to keep running in the same direction until the slope changes. That persistence is where the big money lies. Do you ever catch yourself doubting a trend because it's gone too far? Ask yourself, too far compared to what? The water doesn't stop halfway down the hill because it thinks it's moved enough. It keeps running until it reaches a new level. The same is true for price. A stock doesn't reverse just because you think it should. It reverses only when the balance of supply and demand tilts the other way, when the slope itself changes. Until then, the only logical course is to follow along. Of course, this doesn't mean you buy blindly or sell blindly. You must always protect yourself. The line of least resistance is your guide, but discipline is your shield. When the slope changes, you change with it. If you're long in an uptrend and the highs stop climbing, if the lows begin to break, that tells you the slope is shifting. You don't argue. You don't pray. You obey. You step aside or reverse. That flexibility is what keeps you alive, and patience, don't forget patience. Sometimes water pools before it finds its next channel. It looks still, but pressure is building beneath the surface. That's a trading range. Impatient traders waste money buying and selling in the chop, while patient ones wait for the break, for the water to tip again. Once it tips, the new line of least resistance appears, and the move begins in earnest. Do you see how patience ties directly into this principle? All of this comes back to one idea: markets move because of pressure, and pressure releases along the line of least resistance. Your job is not to predict or to force, but to observe and to follow. If you can train your eyes to see the slope, and your will to obey it, you place yourself in harmony with the natural law of price action. And in trading, being in harmony with the market is everything. The line of least resistance is revealed through patterns of higher highs and higher lows, or lower highs and lower lows. That may sound like a simple bit of chart talk, but in truth it is one of the most powerful tools you can ever learn as a trader. Because when you strip away the confusion, The opinions, the news stories, the rumors, what is left is price itself, and price leaves clues in its own footprints. Those footprints are the series of highs and lows marked across the tape. When you read them right, they show you exactly where the line of least resistance lies. Now picture a stock climbing steadily. It makes a push upward, pulls back a little, then rallies again, reaching a new peak higher than the last. Each retreat is shallow compared to the push forward. Each new low sits above the one before it. What is that telling you? It's telling you that buyers are stronger than sellers. Demand is pressing against supply and winning each time. The pressure is tilted upward. That stock is traveling along the line of least resistance, pointing higher. Do you need a newspaper headline to confirm it? Do you need a broker's tip? No, the action itself is proof enough. The higher highs and higher lows are the signature of strength. In reverse, think about a market that keeps sagging. Every rally attempt stalls sooner than the last. Every pullback dips lower, lower highs, lower lows. The pattern spells weakness in black and white. Sellers are stronger than buyers. Supply is pressing harder each time, and demand is too feeble to push back. That is the line of least resistance pointing downward. If you're buying in such a situation, you are fighting a tide that only one outcome awaits: loss. The tape is warning you clearly, but only if you are humble enough to read it. Why do these patterns matter so much? Because they capture the psychology of crowds. When a stock keeps making higher highs and higher lows, it shows that optimism is building. Traders are willing to pay higher prices to own it. Pullbacks invite new buyers who missed the last leg. Each dip becomes shallower because confidence grows. The line of least resistance is not just lines on a chart, it is the collective emotion of thousands of participants voting with their money. Doesn't that strike you as more reliable than a single analyst's opinion? The same holds for downtrends. A series of lower highs and lower lows means fear outweighs hope. Every attempt to rally runs into quicker selling. People are eager to get out, and new buyers are reluctant to step in. That cascade feeds on itself until the slope steepens. You don't need to ask why. Fear itself is enough explanation. And the footprints are there, plain as day, if you look at them without bias. Now, many traders ignore these clues because they seem too simple. They'd rather complicate things with elaborate indicators, formulas, and predictions. But ask yourself this: what could be clearer than price itself? When a stock shows higher highs and higher lows, the trend is up. When it shows lower highs and lower lows, the trend is down. That's the law of the market. Would you ignore a weather vane spinning in the wind just because it's too obvious? Let's take a closer look at the structure of these movements. In an uptrend, the important signal isn't just the higher highs, it's the higher lows that matter even more. Why? Because a higher low shows that demand stepped in earlier than before. Buyers refused to let the stock sink back to the old level. They showed eagerness. That eagerness proves the underlying strength. When you see that pattern repeating, you know the line of least resistance remains upward until proven otherwise. In a downtrend, the lower highs tell the real story. Each time the stock bounces, sellers step in sooner. They aren't willing to wait for the previous top. They're eager to unload. That eagerness is what drags the line lower. The lower lows simply confirm the weakness. So in truth, when you read the tape, you should watch carefully how the lows behave in an uptrend and how the highs behave in a downtrend. Those are the early warnings of continuation or reversal. Now, let me ask you, how many times have you bought into a stock thinking it was cheap, only to see it get cheaper? How many times have you sold short thinking it was too high, only to watch it climb higher still? That happens because you ignored the footprints. The chart was already showing you the line of least resistance, but you let your opinion override it. You thought you were smarter than the pattern. But the market doesn't pay for smart ideas, it pays for correct alignment with its natural flow. There is also the question of time frames. A stock may show higher highs and higher lows on the daily chart, but lower highs and lower lows on the weekly chart. Which do you trust? The longer the time frame, the more weight it carries. A daily uptrend inside a weekly downtrend may be nothing more than a counter move, a temporary rally before the larger decline resumes. That's why professionals always align themselves with the bigger picture. The line of least resistance is strongest on the broader slope. The smaller moves are ripples in the stream, but the current itself is what matters. Another thing to consider, these patterns are not drawn with perfect symmetry. Real markets are messy. You may see a sudden dip that breaks the sequence for a day or two, only for the stock to resume its climb. That doesn't mean the principle is broken. It means you must look at the overall structure, not obsess over each tick. The market is a living thing, and its footprints are written with human emotion, not with a ruler. The key is to ask yourself, is the general tendency upward with higher highs and higher lows, or downward with lower highs and lower lows? That tendency is the line of least resistance. And what about sideways markets? What if the highs and lows are flat, neither rising nor falling? Then the line of least resistance is neutral. The water is pooling, building pressure. Traders who rush in during such ranges usually get chopped to pieces. The professional waits, patient, until the breakout reveals the next slope. And when the breakout comes, the new sequence of highs and lows tells the story. Isn't it easier to wait for clarity than to gamble in the dark? I can't stress enough how much this one principle has guided me. There were times when I ignored it, thinking I knew better. Every time, I paid the price. There were times I obeyed it, and those were the times I built fortunes. The tape never lies. The footprints are there. Higher highs and higher lows tell you the path is upward. Lower highs and lower lows tell you the path is downward. To trade in any other direction is to step in front of a train and hope it stops. So watch those patterns with care. Don't let simplicity fool you. The most powerful truths in the market are always simple. The man who follows them has a chance. The man who ignores them is already beaten. Every chart you study, every campaign you consider, ask yourself, are the highs rising or falling? Are the lows rising or falling? That's the slope. That's the flow. That's the line of least resistance speaking directly to you. Fighting the market's natural direction is the fastest way to lose. Every trader learns this, though most learn it the hard way. You cannot bend the market to your will. You cannot force prices to turn because you believe they should. The market is bigger than you, bigger than your account, bigger than any opinion. It does what it wants, when it wants, and the only question is whether you will flow with it or fight against it. If you fight, you will lose. That is the immutable law of speculation. Think of a man standing in a river, trying to push the current back upstream with his hands. Can he do it? Of course not. The water will always win, because it has the greater force. The market is the same. When prices are in an uptrend, shorts who fight it eventually drown in losses. When prices are in a downtrend, longs who refuse to let go get dragged under. Do you see the picture? The current doesn't stop just because one man wishes it to. And yet how many traders behave as if they alone can stop a wave that millions of others are fueling? It usually begins with pride. A trader looks at a stock making new highs and says to himself, "It's gone too far, I'll short it. It can't go any higher." He's declaring war on the market's strength, but the market doesn't hear him. The demand is real. The buying pressure is there. Each rally invites more buyers, not fewer. And the poor fellow is squeezed, then squeezed again, until he finally throws in the towel. By then he has lost not just money but confidence. Why did he suffer? Because he chose to fight instead of flow. The same mistake happens on the other side. A stock is sinking, making new lows. Traders who bought higher are holding on, hoping it will come back. They tell themselves, it's oversold, it's due for a bounce. It can't go much lower. But what is that if not another fight against the market's natural direction? Each rally attempt is smothered by sellers rushing to escape. Each bounce collapses sooner than the last. The longs keep hoping, but hope is no match for supply. The line of least resistance is down, and down it will go, no matter how strong their desire for a reversal. Do you see how much of this comes from ego? A trader doesn't want to admit he's wrong, so he clings to his position, arguing with the tape. He forgets that the tape is always right. His account balance shrinks, while his pride keeps whispering, "Just hold on, The market will prove you right. But the market doesn't exist to prove anyone right. It exists to express the balance of supply and demand, and it does so without mercy. The trader who fights it is like a soldier charging a cannon barehanded. The great operators of the past knew this law well. They never fought the trend. They waited until the line of least resistance was plain, and then they went with it. They didn't argue with new highs, they bought them. They didn't argue with new lows, they sold them. That is why they lasted while others went broke. Isn't that lesson worth taking to heart? There is a danger here too, because human beings are stubborn. We are wired to believe our opinions. Once we have a view, we cling to it. In everyday life, that trait can sometimes be useful. In the market, it is fatal. The tape doesn't care about your logic, your analysis, or your reasoning. It only cares about force. If you ignore that and keep fighting, you are signing your own financial death warrant. Think of all the stories of ruined traders. What do most of them have in common? They held on too long. They fought too hard. They refused to cut their losses when the market showed them they were wrong. They let one trade, one opinion, grow into an anchor that dragged them under. And all because they believed they could outlast the market. But the market has more money than you, more patience than you, more power than you. To fight it is madness. Now, let me ask you, have you ever found yourself averaging down into a loser? Adding more because you thought the stock was too cheap to keep falling? If you have, you already know the pain of fighting the market. Averaging down is nothing but a stubborn duel with the line of least resistance. You are saying, I don't care that the trend is against me. I'll double my bet. That is the path to ruin. One bad move becomes two, then three, until the account is shattered. Professionals never average down. They cut the loss, admit the market is right, and live to fight another day. And what about taking profits too soon when you're actually in line with the market? The two can be a kind of fight. You're resisting the trend, doubting it, thinking it must reverse at any moment. So you snatch a small profit and watch the stock soar without you. You fought the flow in a quieter way by refusing to ride it fully. Fear kept you from trusting the line of least resistance. That's another costly battle. The cure for all this is humility. The market is the master. You are the student. When the tape shows strength, you accept it. When it shows weakness, you respect it. Your task is not to impose your will, but to obey the law of price action. That doesn't mean blind submission, it means disciplined observation and action. It means you never let your opinion stand taller than the evidence on the tape. Think of it as sailing. A sailor doesn't fight the wind. He studies it, trims his sails, and uses it to carry him forward. The market is your wind. If it blows upward, you set your sails for long positions. If it blows downward, you trim for shorts. If it's calm, you wait. But to fight the wind, that's suicide. And yet, day after day, traders do just that. They fight instead of sail. They struggle instead of flow. And the sea always wins. There is also greed to consider. A trader may see the market trending but want more than it gives. He says, yes, it's going up, but it should go up faster. It should reward me sooner. And when it doesn't, he grows impatient and starts fighting the rhythm, jumping in and out, forcing trades. But the market won't be rushed. It moves at its own pace, and the impatient man is left battered, while the patient one rides calmly along. Isn't it better to accept the market's pace instead of demanding your own? Fear works the same way. A trader sees the trend but doesn't trust it. He fears a reversal, so he hesitates. He misses the entry, then chases too late. Or he cuts profits short, resisting the natural continuation. Fear makes him fight against the very direction that would have carried him to profit. Both greed and fear are fights against reality, and in markets, reality always wins. This principle of not fighting the market ties directly back to discipline. Discipline means cutting losses when the trend is against you. Discipline means staying with the trend when it's in your favor. Discipline means waiting when the direction is unclear. All three require the humility to obey the tape instead of wrestling it. Without that humility, without that discipline, you are doomed to repeat the same battles, losing money, energy, and confidence each time. So when you look at the market, Ask yourself one question above all others. What is the natural direction right now? If it's up, don't fight it by shorting. If it's down, don't fight it by buying. If it's sideways, don't force trades where none exist. Fighting the market is the fastest way to lose, because it pits you against a force far greater than yourself. The why behind moves is less important than the what shown in price action. This is a principle that confuses most traders, because human beings are trained from childhood to ask questions, to look for reasons, to demand explanations for everything that happens. If the market goes up, people want to know why. If it goes down, they want to know why. They run to newspapers, analysts, economists, television commentators, anyone who can offer a story that makes the move feel logical. But let me tell you something, those stories will never put $1 in your pocket. They will only keep you distracted while the market continues to do whatever it was going to do in the first place. The tape doesn't care about explanations. It only cares about expression, and that expression is price. When you see a stock rising, that's the what. The demand is greater than supply, and buyers are lifting it higher. When you see it falling, that's the what. Friend, let me tell you something straight from the shoulder. In this business of trading, you're not fighting the market, you're fighting yourself. You're wrestling with your own fears, your own greed, your own impatience, and nothing brings those out of hiding quicker than risk. That's why we talk about rules for handling it, because without them, you'll get chewed up and spat out before you've even started to learn what this game is all about. Do you know how many men I've seen wiped out simply because they thought rules didn't apply to them? More than I care to count. They didn't lose because the market was against them. No, they lost because they were against themselves. Now you may think, well, I've got a sharp mind, I've studied charts, I've read the books, I've followed the greats. But let me ask you, when you're in a trade and the ticker starts running against you, do you really believe you'll follow that wisdom you memorized? Or will you hold on, just hoping, just praying, thinking maybe tomorrow will be different? That's where rules step in. Rules aren't for the easy days, my friend. They're for the hard ones. The ones where your gut turns and your palms sweat. They're the guardrails that keep you from steering straight off the cliff. I learned a long time ago that the first rule of risk is simple: never lose big. Small losses are tuition. They're the cost of staying in the game. But a big loss, that's the one that takes you out of the running. And once you're out, you don't get back in. This market has no pity, no memory, no care for what you want or need. It doesn't even know you exist. Do you see why protecting yourself comes first always? You can't win tomorrow if you're broke today. When I was younger, I thought I could outsmart the market. I'd see a setup, bet too big, and when it went against me, I'd add more, convincing myself it had to turn. It's only a matter of time, I'd tell myself. That's the talk of a fool, and I played that fool many times. The market kept teaching me the same lesson until it finally sank in: if you don't respect risk, you're finished. Tell me, would you ever walk into a card game and shove your whole stack in on the first hand? Yet that's what so many traders do every day. Now, let me bring it closer. Imagine you're risking 10% of your account on one trade. Doesn't sound too bad, right? But think about it. You take 10 trades in a row that don't work. Now what's left? Almost nothing. You've crippled yourself before you've had the chance to see your edge play out. Why would you handicap yourself like that? Risk, my friend, is about survival first, profit later. You want to know the truth. Most traders fail not because they can't find good trades, but because they can't manage bad ones. They're too stubborn to cut a loser, too greedy to take a small gain, too reckless to size properly. Haven't you ever caught yourself saying, just a little more, it'll come back? That's the poison talking. That's the whisper that empties accounts. So what's the antidote? Rules. Hard, fast, unbreakable rules. You set your stop before you buy. You know your maximum loss before you enter. You decide how much you're willing to risk, not in the heat of the moment, but in the cool light of reason. And when the line is hit, you get out. No questions, no excuses, no maybes. Do you think I enjoy taking losses? Of course not. But I'd rather take a small, controlled cut than face the butcher's knife. And let me tell you another thing, risk isn't just about losing money. It's about losing your head. A trader without discipline is like a drunk at the wheel. He may think he's steering fine, but sooner or later, he's going to crash. Have you ever noticed how one bad trade leads to another, and then another? Because you're chasing, trying to make it back. That's not trading. That's gambling with panic. That's what happens when you don't have rules to hold you steady. Now, think about position size. Too many fellows treat it like an afterthought. They find a stock they like, and they throw half their account at it. That's suicide, plain and simple. The only thing you can control in this game is how much you risk. You can't control the market. You can't control the news. You can't control the crowd. But you can control your bet size. Why wouldn't you put all your discipline there? If you keep your risk per trade small, say 1 or 2%, you can withstand a string of losses and still have the powder to keep firing when the real opportunity comes. Wouldn't you rather fight another day than burn yourself out on a single misstep? Let me tell you a story. I remember a man who was sharp, quick, clever with numbers. He made a killing in one stock, doubled his money. He thought he was invincible. Next time he doubled down, and when it turned, he held on, thinking he couldn't be wrong twice. The loss wiped him out. I saw him years later, and he told me he never traded again. Do you see the tragedy? He had talent but no rules. The market gave him rope, and he used it to hang himself. I've always said, the market is never wrong, your opinion is. You may think you're smarter than the crowd, but the tape tells the truth. And when the tape says you're wrong, your only job is to get out. That's all. Why argue with the price? Why fight the tide? Haven't you ever stood on the beach and tried to stop a wave with your hands? That's what it's like fighting the tape. Better to step aside, wait for the storm to pass, and live to trade again. Another rule I swear by is this: never average down. Never. It's the quickest way to the poorhouse. If a trade is going against you, adding more doesn't fix it. It just makes the loss bigger when you finally admit the truth. You don't feed a sick horse and expect it to win the race. Why would you feed a losing trade? Yet men do it every day, and they call it strategy. Tell me, would you lend more money to a man who already owes you and can't pay back? Then why lend more of your capital to a stock that's proving you wrong? Risk management is also about knowing yourself. Some men can't stand volatility. A small dip rattles them. Others can watch a big swing and keep their nerve. Which one are you? Because your rules must fit your temperament. If you set stops too tight, you'll get shaken out. If you set them too wide, you'll bleed too much. The art lies in balancing what the market demands with what your nerves can tolerate. Have you ever thought about that, about how much of trading is psychology rather than math? Here's another truth you need to hear. There's no such thing as certainty in this game, only probabilities. Every trade is a bet, and bets can lose. The best edge in the world will still have losing streaks. Can you stomach 10 losers in a row without throwing your plan away? Because that's where most traders break. They don't fail because their system doesn't work, but because they couldn't endure the rough patch. Do you see now why rules are not optional? They're the backbone. I tell every man who asks me, you're not in this business to be right. You're in it to make money. And making money isn't about winning every trade, it's about cutting losses quick, letting winners run, and keeping your risk small enough so the inevitable mistakes don't destroy you. How many times have you heard of a trader who won 9 trades in a row and then lost it all on the 10th? That's not trading, that's carelessness dressed up as skill. And I'll remind you again, capital is your lifeblood. Lose it and you're out. Guard it as you would your very life. Every dollar is a soldier, and you mustn't send them into hopeless battles. Do you want your army wasted on a lost cause, or saved for the campaign that matters? That's the way to think about risk. Let's talk about leverage. Dangerous thing, leverage. It's a double-edged sword. It makes a good trade better, but it makes a bad one fatal. Too many fellows use it like dynamite in a fireplace. Do you really want to build your fortune on borrowed money that can be called away at the worst possible time? I've seen men who were right about the market but still went broke because leverage forced them out before their idea paid. It's not enough to be right, you must also be solvent. You might wonder, how do you know when to take on risk and when to step back? That's where rules about market conditions come in. There are times when the market runs smooth, clear trends, easy to ride. That's when you press. And there are times when it's choppy, confused, dangerous. That's when you sit on your hands. Do you have the patience to wait? Because most don't. Most traders think they must always be in the market, always chasing action. That's another way they hand their money over. Sometimes the best trade is no trade at all. I could tell you about the times I sat for weeks without a single position, just watching. Men would laugh, say I'd lost my nerve. But when the tape lined up, when the move came, I struck hard, and the profit was mine. Waiting is part of risk management too, waiting until the odds tilt in your favor. Have you noticed how often impatience ruins good traders? They'd rather have a bad trade today than a great one tomorrow. And let me ask you this, what's your rule for taking profits? Because risk management isn't only about losses, it's about gains too. Taking money off the table protects you from giving it back. I've seen traders ride a winning trade into the ground because they got greedy. The same discipline that cuts losses must also bank profits. Otherwise, what was the point of the risk? I could go on, and I will, because this subject is too big, too vital to skim over. Risk rules aren't just numbers on a page. They're habits, ingrained deep. They're the difference between a professional and a gambler. And if you think you can get by without them, let me ask, how long do you expect to last in this game? Because the market has a way of finding out your weaknesses, and it'll exploit them until you're bled dry. Friend, let me lay this bare in the way only a man who has felt the market's claws can tell it. Never risk more than you can afford to lose on a single trade. That sounds simple, doesn't it? Almost too simple. And because it sounds so plain, so obvious, most fellows brush it aside as if it were some children's rhyme. But in this business, the truths that save you are always the ones men are quickest to ignore. Do you know why? Because the market makes you greedy, makes you think you're smarter than common sense. And greed blinds a man faster than fear ever does. You see, every dollar you place in the market is a soldier in your army. They go out and fight battles for you. If you risk too many soldiers in one fight, and that fight turns against you, your whole army is crippled. What chance do you have of winning the war after that? You don't. The man who risks too much on one trade is like a general who sends his whole force charging into the first skirmish he sees. Do you think that general wins campaigns? Or do you think he dies in the mud after the first volley? I've watched men throw half their account at a single idea. They'll puff their chests, convinced it's a sure thing. They'll tell you they've done the homework, they know the story, they've seen the pattern. And then the market twitches against them. That's all it takes, a twitch. And suddenly they're cornered, trapped, unable to breathe, because one trade holds their whole fortune hostage. Have you ever felt that kind of pressure? The sort where every tick against you feels like a knife in your chest? That's not trading, that's suffocation. Now let me tell you something else. The market doesn't care what you can afford in your heart. You may think you can stomach a 10% loss on a trade, but when the red flashes on the tape and your account shrinks before your eyes, you'll discover your limit is far lower than your imagination believed. That's why the rule is clear. Never risk more than you can truly part with. If losing the stake puts you in fear, it's too big. If it makes you sweat, it's too big. If it keeps you up at night, it's too big. Do you want to trade with clarity, or do you want to trade with shaking hands and a pounding heart? When I was younger, I thought I could cheat this rule. I'd see a setup that looked so perfect, so certain, that I'd load up heavy. And yes, sometimes it worked, but when it didn't, it hurt bad. Those big hits took weeks, even months to recover from. And that's the cruel thing about outsized risk. It sets you back so far that even when you get back on track, you've lost time, energy, and confidence. Have you ever noticed how a big loss makes you gun-shy? You hesitate, you second-guess, you choke when the next real opportunity comes. That's the hidden cost of risking too much. The fellows who last in this game don't bet like fools at the racetrack. They size their trades so small that any single one of them could fail, and they'd still be in the fight tomorrow. That's the only way to build consistency, protect yourself from ruin. Because the truth is, no matter how sharp your eye, you're going to be wrong. Not once, not twice, but many times. The tape will turn against you without warning, and if you've staked too much, you're done. Tell me, wouldn't you rather keep your powder dry and fire 10 more shots than blow everything on one that misfired? I'll tell you a story. There was a man in the bucket shops I knew. Bright fellow, full of nerve. He'd make bold bets, bigger than anyone else dared, and when they worked, he looked like a king. But one day, one trade, the market turned. He had his whole roll on it. The loss came fast and merciless. He staggered out of that shop ruined, and I never saw him again in the game. Do you know why? Because he put all his eggs in one basket and then stood under a ladder. The market didn't even notice. It just moved on cold as stone while he vanished. Risk is about survival. You can't make money if you're not around to play. So you must build your rules to keep you alive. That means deciding, before you even think about profit, how much you're willing to lose. And that number must be small, not small enough to bore you, but small enough to protect you. 1 or 2% of your account enough to give the trade meaning, but never enough to wreck you. You think 1% sounds too little. Then let me ask, how many trades do you expect to lose in a row? Because strings of losers happen, even with the best system. If you're risking big, 10 losses in a row wipes you out. But if you're risking small, 10 losses sting, but they don't bury you. Would you rather be stung or buried? And don't fool yourself with the thought that you'll never have that many losers. The market delights in humbling men. It will give you a string of losses just to test your nerve. And when it does, your only defense is the smallness of your risk. Without that, you're at the mercy of fortune. And fortune is the cruelest mistress in the world. Let's talk about temptation. Every trader feels it, the urge to swing big. You see a setup that looks so sweet, so sure, and you think, if I just go heavy here, I'll double my account. That thought is poison. That's the gambler's whisper, and it's the ruin of many, because the setup fails, as all setups sometimes do, and your oversized bet tears your account apart. Do you want to gamble, or do you want to trade? Because trading is not about swinging for home runs, it's about steady singles, steady doubles, letting the compounding do the heavy lifting. I'll put it another way. A man who risks small never dies in one day. He can lose, yes, but he loses in slices, not in gulps. He learns from each mistake without being crushed by it. And over time, those small, survivable losses are outweighed by the gains that come when the tape runs in his favor. Isn't that the kind of game you want to play, one where you live long enough to see your edge shine? Another angle you need to understand is the mental side. If you risk too much, you'll trade scared. You'll watch every tick. You'll panic at every wobble. That kind of trading destroys your judgment. But if your risk is small, you can watch the tape with a cool head. You can let the trade breathe, let it develop, because you know the worst case is still manageable. Which trader do you think wins, the one sweating bullets or the one calm enough to follow his rules? And here's the cruelest irony. The men who risk too much often do it because they want success fast. They can't wait for the slow grind of steady profits. But by rushing, by risking too much, they burn out and fail before they ever get the chance to build something lasting. It's the patient man, the one who risks little but risks often, who wakes up years later with a fortune. Tell me, which road do you want? The quick thrill that ends in ruin, or the long road that ends in wealth? I've stood on both sides, friend. I've made reckless bets. I've paid the price. And I've learned that the only way to stay in this game is to never risk more than you can lose. That rule is not just advice. It's the law of survival in speculation. Ignore it, and the market will make you pay with everything you've got. Friend, Let me talk to you about one of the hardest lessons a trader ever learns, and one that most never do. Sit out when the market is unclear. Patience, that quiet, stubborn, unglamorous thing, is as much a weapon in speculation as any rule you'll ever know. But tell me honestly, do you have it? Do you have the nerve to sit on your hands while the crowd runs wild? Or do you etch? Do you twitch? Do you feel the need to act just because the tape is open and prices are moving? That urge, that restless need to be in the market, is what empties more accounts than bad analysis ever did. You see, most men believe trading is about action. They think if they're not in a position, they're not really trading. They think the profit only comes when you're buying and selling, never when you're waiting. But here's the truth: the waiting is where the money is made. The tape will have times when it's smooth, clear, easy to read, when trends shout at you and all the signals line up. That's when you strike, and then there are times when it's nothing but noise back and forth, confusion, no real leadership, no clean move. That's when you step aside. But how many traders can really do it? Can you? Can you watch the screen all day and not place a single trade because the conditions aren't right? Or does the boredom eat at you until you force something? I've said before, it isn't the trades you take that make you rich, it's the trades you don't take that keep you rich. The market has a way of luring you in during the chop, tempting you with small moves, and then slapping you hard for daring to think you saw clarity in the fog. The men who try to trade every wave end up bleeding from 1,000 cuts. The market doesn't punish them all at once, it just wears them down until they've got nothing left. Have you ever felt that? The slow grind of small losses that eat away at your confidence. That's what happens when you won't sit out. There's a reason I say patience is a position. Sitting in cash isn't doing nothing, it's a stance, a choice, a defensive move as important as any buy or sell order. When the market is vague, your best defense is to stand still. You wouldn't march an army into a swamp, would you? So why march your capital into a market that's nothing but mud and fog? I remember times when I'd sit for weeks without touching a thing. The boys around me would laugh, say Livermore lost his touch, say maybe he'd gone soft. But when the tape finally showed its hand, when the market finally laid out a clear trend, I pounced. And the profits from that one strike outweighed all the noise I'd ignored. Do you see the power of waiting? But tell me, could you do it? Could you endure the laughter, the doubt, the quiet, while everyone else played around in the mud? That's what separates the professional from the gambler. Most traders can't stand still because they confuse patience with weakness. They think if they're not active, they're falling behind. But speculation isn't a race against the man next to you. It's not about keeping up with his trades. It's about guarding your own stake until the time is ripe. The best traders don't measure themselves by how often they trade, but by how well they protect their capital when the market gives no edge. Do you want to be busy, or do you want to be profitable? Because often those two don't go together. The truth is, the market spends more time in confusion than it does in clarity. Real opportunities are rare. They come like seasons. You can't force spring to arrive in the dead of winter, but men try anyway. They throw seed on frozen ground and then wonder why nothing grows. A trader must be like a farmer, waiting for the right season, the right weather, before planting. Can you imagine a farmer pacing his fields in January, tossing seed just to feel busy? Yet that's exactly what traders do when they refuse to wait. Let's talk about what unclear really means. It's when the tape gives no trend, when volume is thin, when leadership shifts from one sector to another without conviction. It's when every rally is followed by a sudden drop, and every dip is bought just enough to fake you out. In short, it's when the market shows you no reliable path. Those are the days designed to chew you up. You think you see something, but it's nothing but a mirage. Haven't you been there entering a trade, only to be whipsawed out minutes later? That's the price of refusing to wait. Sitting out also demands you conquer your ego. You must admit that you don't always know, that the market sometimes speaks in riddles you can't solve. The amateur believes he must always have an opinion. The professional knows when to keep his mouth shut and his money in his pocket. Do you always feel the need to predict, to act, to prove yourself right? That's not trading. That's vanity. And vanity has no place in speculation. I'll tell you another thing: waiting clears your mind. When you're out of the market, you can see it cleanly, without bias, without the emotional weight of a position. When you're in a trade, every tick looks like a threat or a promise. But when you're flat, you can judge the action as it is, not as you wish it to be. Isn't it easier to see truth when you're not tangled in it? There's also this: patience is discipline. And discipline is the backbone of every great trader. If you can't sit out, if you can't resist the urge to trade just because you're bored, then how will you ever resist greed, or fear, or panic? The man who can't wait has already lost, even if he doesn't know it yet. Now, you might ask, but Jesse, what if I miss a move while I'm sitting out? Let me tell you, there's always another move. The market isn't a one-time show. It will open again tomorrow, and the day after, and the day after that. Opportunities are like streetcars. If you miss one, another will come along. But if you chase every car, you'll exhaust yourself and lose your fare before you ever reach your stop. Isn't it better to wait for the one going your way? And here's the paradox: by waiting, you don't actually miss anything, because the trades worth taking are the ones that practically shout at you, the ones so clear you feel you'd be a fool not to act. Those are rare, and you'll only be ready for them if you've saved your money, your energy, and your nerve during the dull times. If you waste all three on chop when the real move comes, you'll be too beaten down to take it. Haven't you ever noticed that? The big move finally arrives, but you're so tired of losing small that you don't believe in it anymore. So sitting out isn't laziness, it's strategy. It's knowing that sometimes the wisest move is no move at all. It's trusting that the market will reveal itself when it's ready, and until then, your job is simply to protect your stake. That's what patience really is: not passive, but protective. Do you see it now? I've always said, it's not the number of trades that matters, it's the quality. A man who takes 3 trades a year, but chooses the right 3, will often out-earn the man who trades 3 times a day. And why? Because he waits for clarity, for confirmation, for the tide to align with his position. He doesn't splash in the shallows, he sails when the wind is strong. Would you rather row yourself ragged, or set sail when the breeze is at your back? Think on this: the market rewards patience, because most men lack it. The crowd wants action, wants movement, wants excitement, and they pay dearly for it. The patient trader takes their money, not because he's smarter, but because he's willing to wait for the fat pitch while they swing at every ball. Patience is the edge most traders never develop, and yet it costs nothing, only the strength to resist your own impulses. Why do you think so few master it? Friend, you must get this through your head before anything else in speculation. Protect your capital first, chase profits second. Every dollar you lose is a soldier gone, and every soldier gone weakens your army. Without capital, you are nothing in this game. No brains, no experience, no courage can help you once you've shot your last bullet. Tell me, would a general charge into a battle without keeping reserves behind him? Would he spend every man on the first clash? Of course not. He keeps his strength for the real fight, the decisive moment. Yet how many traders do you see throwing their capital at every flicker on the tape, as if they had an endless supply? I've seen more men go broke from carelessness with their stake than from bad ideas. A bad idea managed well is just a scratch. Careless risk, though, can cripple you even when you're right. That's the irony. The market might even prove you right in the end, but if you overcommitted early and couldn't withstand the drawdown, you'll be gone long before your thesis plays out. Have you thought about that? That you can be right and still lose simply because you didn't protect your capital. Now let me tell you something important. Profit is seductive. Capital is boring. Everyone loves to boast about how much they made on a trade. Nobody brags about how much they didn't lose. But do you know which one matters more? It's the money you don't lose that keeps you in the game long enough to collect the money you do make. Loss prevention is invisible profit. Every dollar you protect today is a dollar you can send out tomorrow to fight again. Isn't that the only way to build lasting wealth? Think of trading like building a house. Your capital is the foundation. If the foundation is cracked, the whole structure collapses no matter how beautiful the rooms look. So what's the use of chasing fancy profits if the ground beneath you is crumbling? That's what happens when you chase money before guarding your base. You may hit a lucky streak, but sooner or later, the cracks spread and the whole thing falls in a heap. I remember a man who hit a hot run in the market. He turned a small stake into a fortune in just months, but he never respected the idea of protection. Every time he won, he pressed harder, doubled up, and left nothing behind in safety. And then, as sure as sunrise, the market turned. Within weeks he gave it all back and more. One day I met him, and he said, "Jesse, I had it all, and I let it slip through my fingers." And I told him plain, you never had it, because you never protected it. Do you see? Money that isn't protected is money already lost, it just hasn't left you yet. Capital protection isn't just about stop losses, though those are vital. It's also about knowing when not to play, when to keep your chips in your pocket. There's no law that says you must always have a position. Cash is a position, and sometimes it's the strongest one. Protecting your capital means refusing to let boredom, pride, or the fear of missing out trick you into throwing money into a market that offers no edge. Haven't you ever felt that itch, that urge to trade simply because you're watching the screen? That itch is the enemy of capital. Scratch it too often, and you'll bleed yourself dry. The market gives no medals for effort. It only pays for correct action. Protecting your capital means waiting until the conditions are right, until the odds tilt your way, and until you can enter with both confidence and control. Anything less, and you're gambling. And gambling is how men hand their capital back to the crowd. Do you want to gamble, or do you want to speculate? The difference lies in whether you protect your stake. I'll tell you something else: the importance of capital protection grows as your capital grows. When you have a small stake, losing half of it hurts, but you can rebuild.